Welcome everyone. We'll give it a couple minutes here to get started. This is our required disclaimer disclosure time, um, and also time for people to log in and get going. As always, for compliance, presentation is for informational purposes only. Before you act on anything we talk about, talk with your personal advisor that knows your plan inside and out, and knows what's right for you. So this is our second quarter of 2026 Path Forward webinar. There's a lot going on, and we find these systematic, repeating webinars where we walk through everything that's going on, the various themes. Not only obviously good for communicating to our clients, but also good for Justin and I. For those that don't know, I'm Ryan Moomey, the CEO of Sollinda, and joining me is Justin Greenhill, my partner and our Chief Investment Officer. We get together and talk about the markets a lot. We have a YouTube channel, which we release 2 videos a month, where we do a quicker, condensed version of what we're doing today. But anyways, let's get started. Let's turn it over to the themes. Justin, what are the themes we're going to cover today?
Today's themes. Thanks for joining. Financial markets since Iran conflict start. This is something we have to apologize, but if you put together the visuals for this one, one day it's going to be somewhat outdated by the next. But we think we're going to capture the big picture of what's happened in the Middle East in financial markets over the past 6 or 7 weeks. The next category, interest rate, volatility, credit, and private market risk. Don't want to spoil that. There's a lot there. The domestic economy, we're going to hit on that. What's happening in the labor market, what's happening with inflation. And then the final section, we're going to call this what's happening abroad, also known as the tour.
The tour. But again, appreciate everybody that's joining us. We will go and get started. So, what's been going on in the financial markets since the conflict in Iran started? This chart looks at a lot of different things since the beginning. It looks at crude oil, the S&P 500, gold, copper, the 2-year Treasury rate, which again mostly tracks what the Federal Reserve is expected to do, and then as well as the transits through that all important strait. Justin, what are you seeing from this?
Just big picture, you can see that transits dropped and the financial markets, initially repriced. Oil higher. You can see notably copper moved quite a bit lower, which can be a barometer for the electrical build out of the world at this point. You saw interest rates go up. You saw gold also interestingly drop over 7%, and you saw the S&P 500 at one point. I think it got down close to 7% or so from the highs. But as I mentioned earlier, these numbers are about 2 to 3 days old here. So the market is now, interestingly, S&P 500 back to firmly positive year to date. So
Yeah, I mean, my takeaway is there was an energy, shock. The energy market's still in shock mode. Brent crude's still up. And for us, I would say one of the most interesting thing is copper. Could that be, is that some of the speculative fluff that was in there? A lot of people chasing, hot names. Is that just wiping some of that out, or is this a possible early signal of some industrial slowdown? And again, it's hard to know through the noise, because as this chart shows, there has been a lot of noise. This next chart looks at the actual daily transits through the strait, and then how different asset classes have responded to it.
yeah, this one's a little bit noisy, but we're going to credit Claude AI for coming up with these last two graphics, which is pretty remarkable. You can just kind of tell it, here's what I want to put onto a chart, and it'll find a way to put it on there. So the numbers you see at the top there are key headlines that came out, around the war. So the announcement of the war, key announcements around the strait, the ceasefire, which is the most recent one you see in green there to the far right. And then you're looking at the same markets we looked at on the prior slide. So you see a big drop off in transits through the strait. You see the orange line, which was oil, initially up a lot and then back down some. And then the other lines are basically the stock market, which, relatively speaking, move very little and are now already in full recovery mode.
Yeah, I mean it's a major. I mean it's a shutdown of a major artery of crude oil. Again, crude oil is fairly inelastic. The global economy needs it. And historically, it's had a shutdown like this would have had a much more dire reactions from various markets. And while some investors, rightfully so, felt the 7 to 8% drawdown was substantial, but from a historical standpoint, it wasn't as bad as it has been. Again, next chart in the bigger picture is household wealth um, as a percentage. The top 1%, the next 9%, the next 40, and then the bottom 50. And this just shows that the um, concentration of financial assets and household wealth is has continued to grow.
Yeah, I think you could maybe have two big takeaways from this. You could say that, the so-called K-shaped economy has continued to grow, but you can also say that the bulk of savings in the country, increasingly so, are now in financial assets. So 401ks, IRAs, et cetera. And I think we started talking about this as recent as the webinar we did 1 year ago, this time during the tariff dynamic. But the big risk, medium term to long term to markets, is if these holders of stocks start to sell. So the aging domestic population demographic, but also a lot of big pools of money overseas, and that's something we'll start to talk about a little bit later in the presentation here. But this
Yeah,
is the
also,
base of assets right here, right?
yeah, this is part of the resilient consumer argument. Why are earnings, projections continuing to rise or hold steady? Why are markets not selling off? There's a lot of financial assets being held by a few folks, and better positioned to handle any shocks from oil, meaning it's going to be harder to get a demand destruction kind of environment. Anyways, next slide looks at crude oil. We're going to look at it for the next two slides. First one just tracks WTI. Obviously, it sat around 60. We talked about it was range bound for a long period of time, almost 2 years. And you see, as you've seen in several, that there was a substantial shot higher, and it's come down since last week.
Yeah. So I think it's pretty safe to say at this point, for at least some period of time, the market here in oil is probably going to hold price levels higher than what we saw before the initial shock. But important to really start to think about, and we'll talk about this also as the presentation goes on, is a world with oil at higher prices kind of puts new catalysts into both the real economy and the financial markets. And, we're in a different world here. So, moving ahead to this one, I think just to be brief, this is kind of a wonky chart for those that aren't aware, but the dotted green line at the bottom shows the forward term structure in oil prior to the conflict in Iran, so 6 months ago. And basically, you can see that the curve shows the front end is low relative to the long end, meaning there's no supply crunch in the physical world. Versus now, what's interesting is you can see that the market really hasn't changed that much in terms of what it expects oil to be 6 months, 12 months, 2 years out in time. But there is a massive shortage of physical oil, which is what's represented by those dots to the far left of the chart.
And that again is back to a delayed response from the markets, which, as Justin said, we'll talk about. We'll talk about a little later. Um, so these charts, they track market breadth, percentage of stocks above their 20, 50, and 200-day moving averages. These are just real simply used as times to identify periods of extreme optimism or extreme pessimism, um, and all of them have normalized here of late.
Yeah, I think one of the things you can kind of see in this chart is that obviously the one at the top, which is percentage above the 20-day moving average, is going to fluctuate a lot. But if you move to the bottom of the chart, this is percentage of stocks above or below their 200-day moving average. And this is, as seen as a much slower moving indicator. And, if you assume the recent uptick since the ceasefire is right there to the far right, you can actually see just based on history, there's plenty of room for the market to, further accumulate a broad advance across, basically all stocks at this point.
Next chart looks at the forward price to earnings ratio of the Mag 7 without Tesla in there. We've looked at this periodically because, again, these are very large pieces of the overall market. So they tend to, their price action tends to drive the indices. The AI high big tech premium has normalized. They're no longer wildly expensive relative to the rest of the market.
Right. It's been pretty remarkable. And it basically just goes to show that these companies, the Mag 7, have really been flat to, in some case, in the case of Microsoft in particular, down pretty substantially since around November of last year. And during that same period of time, you've had small caps, industrials, materials, these cyclical areas of the economy actually go up in anticipation of earnings growth versus the Mag 7 hasn't done anything or is to down and has continued to have substantial earnings growth. So from here, we think that there may be a few things lining up that show, if one was cautious on the biggest of big companies because of overvaluation, that is now a stale thesis, I think is what we're saying.
Next chart, again, we talked about it, looks at 1973, the last big oil supply disruption. What you see now is there was a delayed response from equity markets before they began their prolonged decline.
Yeah, this is an interesting chart here. Bear hope, we're going to call this. If you're a bear in the stock market because of oil, this is your chart right here. So, as always, we think it's important to have two competing ideas in our mind at the same time, right? That we can oscillate between. And this is a great way of looking at it. If you look at historically to the last time oil had a shock, you could say that it took some time for the market to deteriorate, the stock market. But we also have to acknowledge that this time around, the market could be looking through a temporary disruption for good reason. And that's, something we can continue to kind of touch on as this presentation moves forward.
Yeah, and this is a slide. This is one of the last slides we added where it's in essence looking. It's from Goldman Sachs, and it's looking at how long the strait is closed, what their projection is for out in time for the price of oil. Baseline is 6 weeks, kind of where we're at now, and then you go out to 10 weeks. With again no production scarring, meaning production's able to just turn right back on. Um, and then the red is a severe scenario where additional bombings, there start to be production facilities damaged. Again, much to our point earlier, okay, the markets absorb this really well. Oil will come down if we think everybody's looking for a ceasefire here, an agreement on both sides. The question is how long it goes. But everybody's anticipating higher oil prices, right? And as Justin mentioned earlier, what that does to the markets, various markets, asset markets, bond market, inflation, is to be determined. What worked the past year and a half in this environment with higher oil prices won't necessarily look the same. There will be different outcomes.
Yeah, I just think it's remarkable too that we should point out what was it back in 2008 when there was this narrative around peak oil. At the time, if people talked about shutting down the Strait of Hormuz, or however, excuse me if my pronunciation is not perfect there.
You
I
didn't
forget,
call it a ladies'
what did you
handbag
call it? You
company.
called it the Strait of Hormuz the other day, I believe.
Yeah.
Anyway, regardless, people used to talk about how oil would immediately be 300, 400, $500 a barrel if that would happen. So I think this just goes to show that there's plenty of production in other parts of the world. It's just a matter of how quickly can you get it moving, right?
Moving on to our next section, I'll pause here to point out there's a Q&A button. If you have a question percolating, fire it in there. At the end of the session, we'll answer any and all questions. So getting into interest rate volatility, credit, and private market risk, it's been a headline grabber, if you will. This just shows the move index, which is the volatility of the bond market, shows different periods of stress. And as you see here, it rose up in a similar fashion. The volatility of the bond market of interest rates, very similar to the last couple time frames when we saw some dislocation, some fear driving the market.
Yep. Similar to kind of what we saw in other markets, whether it be precious metals or certain areas of the stock market, there was a really crowded positioning in some of these trades. And in hindsight, what it looks like you're seeing here, what caused this sharp spike in interest rate volatility was obviously the oil price made the market think that the Fed would not be able to cut rates and may have to do the opposite. But at the same time, it looks like the broader hedge fund community, which is billions and billions of dollars, might have had some trades on anticipating lower rates on the front end because the Fed was going to cut, and higher rates on the long end because of the deficit and things of that nature. And that quickly got unwound. So what we saw was one of the biggest moves in 2 year yields over a period of about a week or two that we've seen historically. And that is, in fact, an opportunity if one does think that oil will not permanently impact inflation.
Moving on, looking at credit spreads, and again, that's the difference between what people pay for non-U.S. treasuries, debt issued by U.S. corporations. And this shows that it's been mostly contained. Bond spreads did not widen that much. I'm going to move on to this next chart because this line that's in gold here is in black on the next one, but it overlays the investment grade, higher credit quality bond spreads with that of the BDC spreads, which is what's been in the news quite a bit. Um, and as you see, they've had a different experience of late, even pre the Iranian conflict.
Yeah, this is a head scratcher for a lot of people that just look at historical context in terms of the credit market, because normally in a couple scenarios over the past few years, one would have expected to see spreads in your high grade and high grade financial sector bonds start to widen, but there's just so much money in the world that has to be invested in things that are not stocks, in this case bonds. And the corporate bond market, particularly domestically, is just so massive that it's gonna, really take a lot to shake that money out, right? It's a very long-term capital, let's just say.
Yeah, if you hear us talk about flows, that we think has helped suppress those spreads because there's so much money that's just indiscriminately buying, again, high grade, higher credit quality U.S. corporate debt. Again, U.S. credit, we've used this chart before for a long time, um, has been deemed based on volatility the least risky asset class when compared with equities, and then the currency markets.
When we're looking at some of these clear risk indicators or possible risk indicators within credit, we have to just constantly keep in mind that things are different this time. And as humans, we're going to have a bias to think about the global financial crisis and how that originated in mortgage-backed securities because there are a lot of similarities here, right? Undeniably. But we also have to acknowledge markets are different, flows are different, and policy response is different. Monetary and the Treasury now, central bank are they're recession fighting hard, aren't they?
Yeah, right. Um, so real quick on two slides, what could cause some stress to the bond market? We're not saying it will, but what could is one, there's a lot of debt looming in the technology sector that's attracted a lot of need for borrowing, the AI capex that we've talked about, and this just shows that it ramps up over the next 5 years to where if interest rates move higher, if there's still some concerns about private credit, it could be a tough road ahead for some areas of the debt market. And back to private equity, private credit, software, which as we know has a very short time frame, and debt issued to fund the building of software is considered normally a little risky, short half life, right? And as we see here, shares of private equity deals have favored software and technology um, really since the creation of the asset class.
Yeah, having tried to do a little bit more of a deep dive in the last, call it month or two on just the software space in general, what has surprised me is this exact chart, how much private money, be it private equity, venture, things of that nature, debt based are actually in the software ecosystem. And we're not talking about, Microsoft or Salesforce. We're talking about there are all sorts of like niche software companies that, serve a very small, seemingly small, but I guess it actually is large enough or was a large enough audience, a dentist CRM and things of that nature. So to your point, the worry is there's debt in software and that software will be disrupted by AI is what the market's focused on.
Reminder: the Q&A button at the bottom of your screen. If you have a question, feel free to submit it there. Moving on to the domestic economy. First chart looks at various measures, some of which we've already looked at, as it looks recently at the Iranian conflict. Looking at again, oil, Fed funds futures rate, inflation, and the labor market.
This is the game of which chart does not look like all the rest,
Yeah.
and the top left. So to be determined, but at least thus far, and these are slower moving indicators, no doubt, but this shock in oil, hasn't really materially changed the big picture backdrop. So I guess all eyes on, if that does start to happen, but the reason they call inflation core and not core, and sometimes energy is excluded from all of these indicators, is because it can in fact be transitory. And currently, that is what the market seems to think more and more day to day.
And that's even with the recent, last week the CPI measure came out much hotter than expected. Um, so again, is it a temporary shock with oil, which seems to be what everybody's pricing in, or does it have some legs to it? You know, we'll see. We'll see in time, and that's back to the reference to the 73, right? Is there a lag on it impacting the consumer, the economy, companies, et cetera, price pressures? The market now, as it's positioned, seems to be looking through that it's going to be a nothing burger, and that's why we use data as our input because data can't lie. It's not an opinion. It's reality. Next chart looks at U.S. personal spending. Even before the Iran war, there wasn't much excitement over the strength of the American consumer spending.
Yeah, and this has been one of those things too that if you've wanted to find something to be negative for the past, 2 years or so, you could say that American consumption, consumer spending, sentiment around that also has been in a negative to increasingly negative environment. But as we've kind of talked about, though, the aggregate consumer is not as meaningful in terms of what that means in the stock market relative to either the high-end consumer or, in the case of the S&P 500, it's AI capex at this point that's driving, those earnings. It has nothing to do with the consumer. So that is a big difference between current markets and stock market economy correlation of the past.
Because that, I mean, as we've talked about, that's never happened before, where that much corporate capex investment spending has overtaken the volume of spending by the U.S. consumer. So again, we're living through a major macroeconomic input change right now, and where it goes from here, we'll report back, on our next series. This looks at U.S. import prices. Again, very inflationary. They obviously pass this down to consumers. And prices have been accelerating even before the oil shock that we spent much of this webinar talking about.
Yeah, the term that's floated around here is shrinkflation, which is basically you have a environment where in a whole variety of different types of consumer products around the world, the manufacturer can now shrink the amount they're actually putting in the package or whatever it be by a small amount and still kind of keep things stable. It's really just a matter of, does this accelerate or does it just kind of drop back down? And assuming that things do kind of get resolved in terms of global sea transit, this event could prove to be more deflationary than inflationary, and perhaps.
Similar to the argument of technology, right? Um, wide adoption of technology is since the late '90s has proven to be a deflationary force versus an inflationary force. So to Justin's point, um, we will see. Last section before our Q&A. Again, bottom of your screen. If you have a question, hit the Q&A button, type it in. We will discuss at the end. But now looking globally, let's go on a tour around the globe. What's happening? First chart looks at everybody was betting against the U.S. dollar to begin the year, and with the Iranian conflict, that got unwound pretty quickly.
Yeah. Anyone looking at any kind of assets outside of the US, it would be very valuable, we think, to pay attention to not just this chart, but various, offshoots of this chart, which basically this is just showing what are the market participants who are not hedging something in the real economy, how are they positioned, generally speaking, on the dollar. And as you can see, this kind of over time oscillates from being positive on the dollar or negative. And what's interesting about this current moment is for reasons that had nothing to do with Iran, there was negative positioning in the dollar. And then one would think that when a risk off event happens, there really is a switch, and then there's a scramble for global money to buy dollars and to undo these positions. And we really didn't see very much of that. And since this chart just a week ago, we've actually now seen all sorts of flows start to very quickly get short the dollar again, which just goes to show the big picture theme that we've been talking about for about a year now is we, in hindsight, last year probably started a new cycle of at least equal to outperformance from some, or if not many, global stock markets and the US stock market. And thus, here we are on the tour.
Yeah, which again, as we've talked about before, that this shift, this last happened 2000 to 2009. Many of you will remember that's often referred to as the lost decade when the U.S. Equity markets did not make money over a 10-year period, but international emerging markets did. So again, watching the dollar, it's not that we're all of a sudden going to start trading currencies. It has major influence on the flow data, right? Where's money going? Where are big pots of investors that control billions of dollars with leverage? Where are they putting money? Because oftentimes that's going to drive price, right? Um, Next chart looks at we've used this periodically. We just thought it's important to continue to talk about the reaction function of energy importers relative to the conflict, what's going on right now. And again, this shows Japan and Korea up top as major importers of energy, and there's not a coincidence that their markets have been very volatile, more so than ours of late.
Yeah. One of the things that Ryan and I started doing, I guess, close to 15 years ago is when we talked about international, we would think like, who needs to import a bunch of oil and who doesn't? And although that's not always the dominant distinguishing factor between markets, it is super important because it just kind of helps you think about how the different, we'll call them flow functions are between like capital that is in a portfolio might wanting to rotate from one to the other. But nonetheless, the big story in Korea, which as you can see here, Korea is super vulnerable to higher energy prices. But despite some volatility, Korea is now the stock market moving higher yet again here in recent days, following what was a record year last year. So key player in the memory component supply chain of the semiconductor industry and obviously AI, as well as there has been some interesting government tax incentives by the new presidency there in South Korea that won election last year, which basically said, hey, if you own any securities outside of Korea, you're going to pay a tax. If you sell them and come and buy Korean stocks, it's tax free. And at least to this point, there's a lot of money over there, right? It's become a very rich and small country over a very short period of time in the last few decades. So that's counteracting this higher oil price vulnerability. And to some extent, the same is true of Japan. And as you can see, top five European economies are extremely vulnerable to high oil. So as we go forward, we are going to be watching if those vulnerabilities stack up, to the countries that are on the top of this list. And in the meantime, some of the countries on the bottom of the list here have done extremely well, and we think that might continue.
Which goes it right into our next chart, right? Which looks at some of the countries around the world, their real rates. And to Justin's point, while Asia's been um, has been struggling, Latin America, specifically Brazil, has not. And if we look at that last chart again, we see Brazil down here. They're a net energy exporter, but they also happen to have real rates in their favor, right? Anyways,
Yeah. So it's kind of important when we look at this, on the tour, which again, I want to remind people we are on the tour right now, the tour of the world, right? So if you're very only domestically focused, cover your ears. But ultimately, high real interest rates, which you can see Brazil has very high real interest rates. So these are rates that are 10% even when you subtract what the inflation is. That obviously has helped stabilize the currency, pays people who invested in bonds a lot of yield, but it does limit economic growth. Versus you go to the top of this chart, you're going to see Japan and South Korea more vulnerable to oil price shocks, but they have much lower interest rate environments, and thus there is capital there that is going into things like technology, semiconductors, et cetera, right? So we want to always kind of separate what's happening in markets that might make them attractive investments versus what is good structurally about an economy. High real interest rates, which benefit investment in Brazil at the moment, are the worst thing for long-term economic development.
and the last point I'll make is think of optionality of their respective central banks. If Brazil has a lot of ammo to boost their economy, is the point. Japan at the top of that has very little, right? But they've been a front runner of economic policy theory and experimentation for a long time. So back to Abenomics. So again, Just an interesting way to look at tying it all together on the countries impacted by the Iranian conflict, high oil prices, and the countries that aren't. But also let's look ahead, right? That's one of the number one feedback things we get from these is don't just tell us about the charts, tell us what we think it means moving forward. And moving forward, there could be some real opportunity in these countries that have been exporters, that are net exporters of energy, and also are in a position of really easy to stimulate. Next chart looks at copper and oil. Going back in time, they tend to trade in tandem, and that hasn't necessarily happened. And this goes back, I mean, decades. We're not talking. This isn't a 6 month chart. This is a 20
Yeah, it's
year,
20 years.
almost 20-year chart.
I mean, this is a really remarkable chart. So we think that one of the more important things about understanding all markets, but in particular commodity markets, is really two different categories of thought. One is there's a lot of money that's going to do price signals. So it could be trend following, could be whatever else. Lots of money is always going to go with the trend, right? In commodity markets, classic strategy. But beyond that, it's important to think about what is the real supply demand. And if you go back to 2007, the supply demand dynamic for copper and oil was really the same thing on the demand side. It was the industrialization of China, right? Basically, during that period of time. So China would want more oil, they'd want more copper. Since we have moved really kind of, let's call it 2018, 19 up until present, especially after the pandemic, copper has become much more of a barometer of, call it the anti-oil future, right? In terms of electrification, it could be data centers, it's batteries, electric motors. More recently, it's components inside of drones, right? Which the military is increasing need of. So we actually think that longer term, there's a pretty real opportunity in looking at copper as the kind of like pro economy asset. It used to be oil, and looking at oil as kind of like this thing that might get shocked on geopolitics, but ultimately demand for oil over time is going down, and that demand is going to copper.
Yeah, but again, this decoupling, this chart, it shows it's happened. The question is, where does it go from here? Again, assuming there isn't some sort of recessionary force, just oil, there's plenty of supply. Crude or oil, there's plenty of supply. Copper, there's actually a supply shortage. So, again, to Justin's point, this decoupling isn't permanent, or will it snap back together, get closer? We'll see in time. Last chart before questions. This looks at precious metal uh, miners, right? Gold and silver miners, and looks at their share offerings. We talked about this on one of these in the last year, a few quarters ago. Justin had mentioned that high gold and silver prices tend to lead to miners issuing more shares because they tend to be smaller, small cap companies that are more reliant on issuing shares to fund operations. And what do we think happened? That's happened.
Oh yeah, I mean, which would make sense, right? Because up until this kind of recent washout, we had a really rapid and, in hindsight, very speculative move higher in all precious metals. So gold, silver, and the miners were just, a moonshot. They've since kind of come down, but now would definitely be the time to focus on the blue chips if one were to want to buy mining stocks, I think. And there are plenty of them out there, right, in terms of what you could buy. But there's also some ones that might, get you on a newsletter. And have you, Boomer precious metal newsletters is a real thing.
Oh, I mean, I've said this before many times that the marketing of, I would say, our industry, the investment industry, specifically relating to precious metals, has convinced people by and large that precious metals are two things, that they're safer than equities and that they cushion the blow if equity markets go down. Neither of those are factually correct, right? Sometimes maybe, but factually incorrect. So we've talked about commodity, like when you invest in stocks, you're investing in capitalism over time, and that time could be a long time, right? You're expecting um, good quality companies to increase their earnings, thereby increasing their share prices. Commodities aren't like that, right? They go through these vicious cycles, which we've showed before, and it's escalator up, waterfall down, which we've seen multiple instances of that. Gold dropping over 20% in a 2 week period, silver dropping 10% in a day. So we just always caution, be exceptionally careful with commodities because, as Justin said earlier, one of these isn't like the other.
Well, and
We
you're in some ways, if you're betting on a commodity to go up for decades and decades and decades, like one expects, you know, good stocks or stock indices to go up, you're kind of betting against innovation and betting against technology. So it's an interesting or maybe helpful framework to think about that, right?
So moving on to our Q&A, got a couple questions. One's a really good one. The past 10 years have called into question the 60-40 portfolio with 60% equity, 40% fixed income. The 40% attributed to bonds are widely being replaced by other assets. That's back to the advent of private equity, private credit, the alternative investments that often restrict liquidity, but they're investing in other assets, oftentimes real estate, oftentimes the BDCs, which we showed an example of, the types of direct credit to companies. What do we think of this? Again, I wish our market strategist Keith was on here with us because he's a firm believer in this, as are we. A real possibility where in a higher inflationary environment, bonds don't offer the protection, if you will, that often comes from a diversified portfolio, right? Stocks go down, interest rates, there's a fleet of safety. Interest rates are driven down, which drives up the price of bonds, thereby offering a buffer to the stock portion of the 60-40. In a higher inflationary environment and in a structurally changing um, U.S. economy where the government is running deficits, significant deficits, even in good times, that creates a scenario that's more equivalent to emerging markets where literally equities can go down and interest rates go up, meaning bonds lose value. So they both go in the same direction, which is counter to the experience of really the last, what, Justin, 45 years, right? It's kind of been the reverse correlation of the two. So we agree, it absolutely can happen. That's part of the reason why Justin and I, created the. We have 10 different strategies, all data driven, but all have different ideologies. What their volatility profile is, and what they're driving at, what they're trying to do, trying to accomplish. And we've created again some liquid return profiles that their intent is to not necessarily be in the bond market, but have bond-like returns, tighter volatility, and lower risk, right? Well, lower volatility than an all equity portfolio, but to remove that risk that bonds stop working for periods of time or for an extended period of time. So, great question. That was a question from an advisor, as you might you might have guessed, but a great one. And the second question has to do with what are we doing right now? Great question, and it has more to do with which of those 10 strategies are you talking about in our longer term asset allocation strategies. We haven't done a lot, other than tweaking some exposures. In some of our more active strategies, where we're trading shorter time frames, we weathered much of the storm of this volatility. Almost all of them were positive, even when the market was down 6 and 7 and 8%. And since the snapback, what have we been doing is we've been redeploying capital, obviously selectively depending on the strategy. If oil, or if the market's correct in looking through this Iranian conflict, then there are some mismatches on relative value. And we believe there are some areas of the economy that will snap back even more so than the broader indices. And that's what we're focusing on right now. We hope that's correct, but we don't know. A couple of those, I'll tell you, it would be in the software space, which we talked about, has been absolutely destroyed. A lot of those names down 40 and 50%. And these aren't, companies without earnings. These are companies with millions, in some cases, billions of dollars of earnings. The other area would be financials, which this is a big earnings week for them. But their relative ratios and performance to the broader market are at historically low levels. And again, if the market is pricing this correct, there's a mismatch there, and there's an opportunity for a risk-adjusted return that isn't available in the broader market. Anything to add on that, Justin?
No, I think that there are some opportunities, and I think just to emphasize that risk management around those opportunities is no doubt important. So for the longer term, more core type strategies that you mentioned, Ryan, obviously our big theme there remains non-US investment. And that's been the case for, well over a year and has led to outperformance. And to some of our slides, we still think that's a theme we're going to stick with. On the shorter time horizon and more tactical, to your point, there's been areas of the market that have just been absolutely annihilated, and maybe for good reason, but it's all connected back to that one graphic that showed the Mag 7 used to be very overvalued relative to the stock market, and people would talk about that was a bubble risk, CapEx was excessive for AI, etc. Versus now, based on the dominance that those companies have, they're trading in line with the market. So maybe in an increasingly uncertain world, some of those companies actually start to, back to talking about flows, receive some of the flows over the next couple months. So we shall see. But risk management, most important when having a tactical view, no doubt.
Yeah, and back to the original question, that's part of what our thesis of is why do we have 10 different kind of strategies, data-driven strategies that are operating on different ideologies, or they're making decisions based on different time frames and signals. It's because we don't think people just want to sit in the aggregate bond and roll the dice, right? And that's the back to many of your advisors have talked to you about blending strategies, right? That's one of our differentiating factors is the ability to do that with ease, to meet each client's individual risk tolerance time frame and objectives for their money. So yeah, but that we're a little over. Apologize for that, but appreciate you showing up and the opportunity to talk shop with you guys. Reach out to your advisor, and if you have questions for us, you can always fire them off to info@sollinda.com, which is on the screen. But again, appreciate the opportunity, and we will see you next quarter.